So, from an overall California perspective, I think there's always been a desire to live here. I think that's the biggest draw for people. We're I think, fifth biggest economy in the entire world, something like
Yeah.
that.
Yep.
So, there's a lot of industry, there's a lot of people here, 45 million plus people who live in California. So, it's a very broad renter market. The housing market is extremely expensive in most of the major MSAs. And so I think the drive for a lot of investors as to why California they feel is a good place to invest is because of that renter demand and the rental growth that has occurred over the last 40 years in California. From the investors that I speak to, and I primarily work in Southern California and Los Angeles, the city of LA, which has more regulations and rent control laws and things that are a little more restrictive. But I think a lot of investors who have grown up in that and have invested in Los Angeles, they understand the barriers to entry, because if someone was from out of state and wanted to come and invest and add value, there's so many nuances to investing here that it becomes very difficult if you don't have the pieces in place to then be able to effectively execute your business strategy. So I think that's why a lot of people invest here. And then it's California, the growth's here, man.
Yeah, yeah. When you put it that way, it's very appealing. But speaking of a couple things that you mentioned there, with especially in the LA market, there's a lot of laws and regulations that kind of could put a hamper on some people. So you talked about one thing like rent regulation, rent laws, and things like that. So how does somebody like get around some of those challenges that you see in LA's market?
Good question. There's a lot of different things that you can do. And for the primary clients that I work with, most of them are value add investors. So because of that, historically, a lot of the strategy in investing in California has been tenant buyouts or buying properties that have low rents because of the rent control laws, renovating the units, increasing the rents and bringing new tenants in there, thus increasing the NOI and then the value. But with the rent control, sometimes you'll have tenants who've been in the units for 10, 20, 30, 40 years, right? And so in those situations, historically, what people have done is tenant buyout agreements, which is basically there's a certain amount of money that you can pay to have a tenant leave that unit, mutually executed, and then they leave, and then you go and renovate and juice the rents. So that's all priced into where their assumptions in terms of where the return on cost is, and how they're going to get to that number that they're underwriting. It's art and a science all in one, but these guys and gals who've been syndicating and value add investing, and those who are long-term holders too, they know the strategy that fits them, and they tend to stick with that strategy and buy buildings that fit that strategy.
Yeah, especially if they're buying in LA, they have to know what the proper strategy is for that market. Otherwise, if you're going in there pretty green, it might not work out well for you if you don't know. Yeah, and that's one of the reasons why it's important to know about your specific market that you're investing in.